All right, let's dive right in. Welcome, young professionals, to this masterclass explainer. Today, we're tackling a topic that is literally dominating the group chats of an entire generation: navigating financial anxiety and actually building lasting wealth. If you've been feeling the squeeze of the modern economy, I promise you, you are absolutely not alone. So, as a financial advisor, I want to walk you through the data, the massive behavioral finance shifts we're seeing, and the undeniable math that proves you actually have a huge, unique advantage. Look, we've got to start by acknowledging the elephant in the room, right? You look at sky-high housing prices, inflation, just general economic anxiety, and it's super easy to see why terms like doom spending or soft saving are trending so hard. According to research from UC San Diego, an entire generation is looking at traditional markers of success, like homeownership, and feeling like they're just completely out of reach. But, as we'll see, this anxiety is actually triggering a really fascinating financial rebellion. So here is your wealth building roadmap for today. We're going to cover 1. The economic anxiety era. 2. Generation investment savvy. 3. The social media trap. 4. The magic of compounding. 5. Beyond stocks and bonds. And finally, 6. Your long-term playbook. Okay, part 1. The economic anxiety era and how we navigate all this pressure. You know, those researchers over at UC San Diego found a really deep distrust in institutions right now, employers, governments. Basically, a feeling that they won't provide financial safety nets anymore. You add to that the guilt over everyday consumption habits, fueled by that endless stop buying avocado toast messaging, and there's just immense pressure to make the right choices. But here's the cool part. Instead of just giving up, this anxiety is actually driving young people to seek absolute financial control elsewhere. Which brings us to part 2, Generation Investment Savvy. You guys are the early adopters. 19. Yeah, you heard that right. According to a recent Schwab Modern Wealth survey, 19 is the incredibly young average age that Generation Z begins investing and saving. Compare that to millennials who started at 25, or baby boomers who waited until they were 35. You are getting a massive, massive head start on the rest of the market. And when we look at the sheer volume of early adopters, it's honestly mind-blowing. Data from the wealth platform Art of Finance shows a striking 54% of Gen Z starts investing by age 21. That dramatically outpaces millennials at 31% and Gen X at 27%. This isn't just a slight uptick, guys. This is a complete behavioral shift in how an entire demographic approaches their early working years. So what actually caused this shift? Well, first off, frictionless micro-investing apps and AI-driven advisory tools completely eliminated those high commissions and clunky interfaces of the past. Second, pandemic lockdowns forced a savings boom and frankly gave people the downtime to learn about markets. And third, researchers are noting that parents, especially immigrant parents, are actively encouraging their kids to invest early to build generational wealth. Moving right along to part 3, the social media trap. Let's talk about hype versus the pros. Now, there is a massive divide out there right now. On one side, you've got social media hype pushed by finfluencers, which is usually driven by adrenaline, status, and highly volatile assets. On the other side, you have professional advice focusing on diversification and long-term safety. But Schwab's data actually highlights some fantastic news here. 76% of Americans are actively swiping past the finfluencer noise and report trusting professional advisors way more than whatever is trending on TikTok. However, that trap is definitely still catching people. Capital Asset Management warns that almost half of young people choose volatile cryptocurrencies as their very first investment. And look, when you focus on speculative instruments driven by social status or just pure curiosity, it very often leads to heavy initial losses. The big takeaway here: don't let the gamification of these apps trick you into taking completely uncalculated risks. All right, part 4. This is my absolute favorite: the magic of compounding. Time is literally your superpower. The math here is just undeniable. Let me put this into perspective for you. If you invest just $5,000 a year at a 7% return starting at age 19, you yield over $1.5 million by age 65. But if you wait just 6 years until you're 25, you end up with under $1 million. Think about that. You contribute just $30,000 more out of pocket, but you gain $500,000 more in retirement. That is the magic of compounding. Rob Williams, a certified financial planner at Charles Schwab, really hit the nail on the head when he said one of the magical qualities of investing is the power of time and compounding and starting early and starting small. Seriously, saving a dollar today and just allowing it to compound over the decades is the true, slightly boring, yet wildly effective secret to building significant wealth. Now, I can practically hear you thinking, okay, but what about my student loans? And I get it, it's a massive burden for young professionals. But IRA expert Ed Slott advises that if you wait until you are completely debt-free to start investing, you sacrifice your ultimate superpower, time. So make your minimum debt payments for sure, but set up a Roth IRA the minute you get your first job. Even if you just automate $100 a month, you're building that psychological habit and putting time firmly on your side. Okay, part 5, beyond stocks and bonds. Let's dig into the modern portfolio. So that traditional 60-40 stock and bond split our parents used, it's essentially dead for the modern young investor. A Bank of America study actually found that 3 out of 4 younger investors say just holding stocks and bonds is no longer enough to build wealth. Instead, they're looking at a modern portfolio that actively incorporates alternative investments to really drive growth. And they aren't just talking about it, they are executing. Strikingly, 51% of Gen Z investors on platforms like Arda already hold private market assets. Actually, a separate HSBC study completely echoes this, showing massive future interest from young, affluent investors in hedge funds, private credit, and private equity. Why the shift? Well, the reason is pretty simple. Alternative investments offer higher potential returns that don't always move in lockstep with the public markets. Historically, this kind of diversification was strictly reserved for the ultra-wealthy. You had to know a guy who knew a guy. But today, digital platforms are democratizing access to private credit and venture capital, allowing you to build sophisticated institutional-grade portfolios right from your phone. Finally, part 6, your long-term playbook. Let's talk about taking action. So here's your playbook. Step 1, automate your early contributions. Harness that math of compounding right now, even if it's just a tiny amount while you're paying down those student loans. Step 2, ignore the finfluencer noise. Keep the adrenaline out of your portfolio and rely on professional, long-term strategies. And step 3, look beyond public stocks. As your wealth grows, you've got to explore alternative investments in private markets to truly diversify. They say the best time to start investing was yesterday, but the second best time is today. You have the ultimate advantage on your side right now, time. So the question I'm leaving you with is this. Are you going to let economic anxiety and social media algorithms dictate your financial future, or will you harness the math, take control today, and build your legacy?